Stock trading. You're buying ownership. A share of a company is a slice of that company's future. Apple goes up, your slice goes up. Apple goes bankrupt, your slice is worthless. Think of it like a fruit stall in a market. Every day, people walk past and decide what that fruit is worth. On a good day, they pay more. On a bad day, they pay less. The fruit didn't change. The crowd did. Stocks trade on exchanges. NYSE, NASDAQ, London Stock Exchange. These are just the markets where buyers meet sellers. Price moves on earnings, news, and emotion. Mostly emotion. You can hold a stock for 10 years or 10 minutes. Long-term holders are investors. Short-term holders are traders. The market doesn't care which one you are. Forex, foreign exchange, the biggest market on the planet. $5 trillion traded every single day. You aren't buying a company. You're buying a currency. Think of it like airport money exchange. You land in Japan. You swap your pounds for yen. The rate changes every second. Forex traders profit from those changes just at massive scale. You trade in pairs. GBP/USD, EUR/JPY, USD/CHF. The first currency is what you're buying. The second is what you're selling. If you think the pound will strengthen against the dollar, you go long GBP/USD. If it moves in your direction by 20 pips, you profit. If it moves against you, you lose. No company, no product, just two currencies fighting each other 24 hours a day, 5 days a week. Crypto, digital assets, no central bank, no government backing, just code, supply, and demand. Think of early crypto like a new currency being invented in someone's garage. Nobody knows if it will be worth anything. Then, a few people believe in it, then more people. Suddenly, the garage currency is worth more than some small country's money. Bitcoin is the original. Ethereum is the infrastructure. Altcoins are the thousands of experiments beneath them. Crypto trades 24 hours a day, 7 days a week. No closing bell, no holidays. The volatility is extreme. The coin can double in a week and collapse in a day. The opportunity is real. So is the risk. Sentiment drives everything. One tweet from the wrong person and the market moves 10% in 60 seconds. Commodities, raw materials, the physical stuff the world runs on. Oil, gold, silver, wheat, coffee, natural gas. Think of it like trading the ingredients before anyone bakes the cake. You aren't buying a loaf of bread. You're buying the wheat before the baker even starts. If a drought hits and wheat gets scarce, your wheat is suddenly worth more. That's commodity trading. Two categories. Hard commodities, oil, gold, metals, mined or extracted. Soft commodities, wheat, corn, coffee, cotton, grown or farmed. Price is driven by supply shocks, weather events, geopolitics, and global demand. When war breaks out in an oil-producing region, oil prices spike. When a frost hits Brazil's coffee farms, your morning coffee gets expensive. Commodity traders position themselves before the world catches up. Bonds. You are the lender. A government or company needs money. They issue a bond. You buy it. They pay you back with interest. Simple. Think of it like being a bank. A friend asks to borrow £1,000 for a year. You agree, but only if they pay you back 1,100. That extra 100 is your yield. That's a bond. Government bonds are the safest. UK gilts. US treasuries. The government has never defaulted. Corporate bonds pay higher interest because the risk is higher. Companies can go bankrupt. Bond prices and interest rates move in opposite directions. Rates go up, bond prices go down. Rates go down, bond prices go up. Bond traders watch central banks like hawks. Every word from the Bank of England or the Federal Reserve moves this market. Futures. You're agreeing to buy or sell something at a fixed price on a future date. The asset doesn't change hands today. The contract does. Think of it like a farmer in a supermarket making a deal in January. The supermarket agrees to buy 10,000 bushels of corn in July for a fixed price. The farmer agrees to sell. Neither knows what the price will be in July. That's the bet. Futures exist for almost everything. Oil futures, gold futures, index futures, currency futures. The original purpose was hedging, protecting against price swings. Today, traders use them to speculate with massive leverage. You can control $100,000 of oil with a fraction of that capital. The amplification works both ways. Fortunes and wipeouts happen in the same session.